This
I'm
conference
going
will
to
now be recorded.
call the meeting of the Montechusett Regional Planning Commission for Thursday, March 23rd, 2023 to order at 7:01. First item is to take roll call of the members. Okay, very good. Uh, Actually, when I call your name, could you please say here? Technically, you should respond with your name again, not just here, but I don't think they'll send us to the meeting jail because of it. So, Alan Pease,
Here.
uh, Jeff Tillotson,
Jeff Tillotson here. I'm not going to jail.
oh, Guy Corbacero, uh, Jackie Doherty.
Jackie Doherty here.
Okay. Uh, Christopher Monroe.
Christopher Monroe here.
Okay, Laura Schifrin.
Laura Schifrin here.
Mary Jo Bohart.
Mary Jo Bohart here.
Rick Ward.
Rick Ward, alternate member here.
Robert Schwartz.
Bob Schwartz here.
And even though he's not a member, I'm going to just call out his name so we know. Roland Lambeau, is it?
Roland Lambeau, I'm here.
Lambeau. Okay. Close, but no cigar. Okay,
Yeah.
very good. And one thing I did forget to read, that we are holding this meeting in accordance with Governor Baker's COVID-19 executive order suspending certain provisions of the open meeting law and remote participation. Votes will be taken through roll call. Okay. Next item on the agenda, once I fire up my other computer. There we go. Announcements. I don't have any, but does anybody else have any announcements they'd like to say? Yep, not hearing any. I will go on to item 2. Guest announcements and questions. Pretty well the same thing as announcements, but do we have any guest announcements or questions?
I just have one question. This is Phil Duffy from Clinton, unrelated to tonight's agenda. I happen to be looking at a NOFA for an EDA Public Works grant. Looking at our SEDS, it expires in July 24. Just wondering if we've got it in the planning in the pipeline to update the SEDS.
Mr. Chairman, I
Can
can take
anybody?
that if you want.
Oh, very good, Glenn.
Yeah, sure, no problem. I'm in the process of updating the SEDS, Phil. It'll be done by this spring, well in advance of the expiration date. It's a project that that prior staff was working on prior to the departure of Chris McDermott, our former economic development manager, and I picked it up and just slowly been trying to get it to the finish line. So we'll be done ideally within 60 days, Phil. So we won't get to the expiration.
And in the past, we've had a SEDS committee that we'll be meeting as a committee again.
Yeah, absolutely. So basically, what I have to do is I've got to put some finishing touches on it. Um, I'm coming out of a vacation and a brief illness now, so basically in March I'll put the finishing touches on it. Ideally, post a meeting, let's say by April 1 for May 1. Have a Mayish meeting, early May, to get it reviewed, adopted. It's got to go out there for 30 days and just get the darn thing done.
Yeah.
But the
Well,
ball,
it's not
and so you know, just for everyone's edification, you know, the loss of the staff just put us behind on doing it, but it'll be done well before that expiration deadline. Yes, sir.
Yeah, which is in 24. So we've got more than a year, but I remember it being a process that took a while.
Yeah, we'll be done within 60.
Oh wow. Okay. Okay.
Okay, thank you,
Thank
Phil.
you.
It's good to hear you again. Haven't seen you in a while. Thank you for stopping in. Okay. Um, Next item on the agenda is the audit presentation by Roland. Would you like to preface this, Glenn, or Roland? Would you like to jump right in?
I'd like to turn it right over to Roland, if that's okay. I'm sure Linda might have a comment or question later. Chris McNamara, Fiscal Assistant's here. I'm here. But we'd love to hear from Roland and make questions, comments later. Thank you, Mr. Chairman. Roland, take it away, sir.
Okay, thank you. I think usually at the beginning, I always wonder whether or not you want to just raise questions during the presentation, excuse me, or whether you want to wait until it's done. There'll be some of the forms I think I had mentioned. Excuse me. Just got to get rid of this thing.
That decision's up to you, Roland. Actually, if you want to ask questions, or do you want to go right through the presentation, or do sections?
Well, I think there's going to be some new items we're going to be discussing, so it's probably best probably to just raise them as we go along, rather than waiting for the end, because either you'll forget what they were, or not make a note of it to bring it back up. Some of this stuff has, like it has been in the past, whenever there's a new pronouncement that you have to adhere to, they don't make it easy, and you'll probably lose a lot of sleep over this tonight, not understanding what I'm even talking about, because it gets to be a challenge to even understand what GASB is talking about most of the time. But we'll get through that, and as I say, anytime you want to just stop for a question, I'll do that. So just to start off the presentation, last year I had mentioned to those of you who've been here for prior audit presentations that some of the discussion will feel repetitive. There will be some of that, but new GASBs and catching up with old ones will be the gist of what I'm going to be discussing tonight. The audit this year, despite the relaxation of COVID, was handled remotely, primarily due to family health issues. Linda was gracious enough to forward along whatever we requested. This gave us the opportunity to review what transpired during the fiscal year as far as any changes in funding sources, staffing levels, and unusual activity. We were provided all materials necessary in order to perform the procedures developed in our audit programs. No restrictions on anything that we would have asked for. So it was, it was, like I say, unfortunately not being able to get out there. We've been trying to do that as the masks have come off and, travel has been opened up a little bit. But like I say, we were a little more restricted on my end this year than anything else. As I indicated last year, while we're still in COVID's grips, I feel that our years of experience auditing the Commission statements, understanding internal controls and financial and accounting peculiarities of the agency help us to mitigate any issues such as COVID, or primarily doing it remotely, that we're still able to render opinions on MRPC's financial position and compliance with federal program requirements. The audit reports reflect an unmodified opinion on the financial position, no findings to be reported on in the areas of internal control and compliance. There's also no management letter. The focus of this year's audit was an understanding of new GASB pronouncements that impacted the agency. I want to start with the carryover items that are on the agenda every year. The first involves GASB 68, which addresses the Commission's participation in the state retirement system. I bring this up every year just as kind of covering the old stuff that still lingers. As of this date, I'm not aware of any resolution regarding any mandatory requirement for the agency to make contributions to the fund, which is kind of puzzling considering that the state continues to contribute on your behalf. And they also send a letter out every year indicating that how much they have paid on the agency's behalf. And that has been tabulated and accumulated, and it's in the footnotes. I don't remember the number off the top because I'm doing 3 planning commissions, and one of them I know the number on their amount that they would have to pay if they went back to the beginning of this is almost $2 million.
Excuse me, Roland?
Yeah?
I apologize. Mr. Cunningham, Peter Cunningham from Groton has his hand up, Mr. Chairman. So I just, Mr.
Oh,
Chairman,
I'm sorry.
Nice, Peter. That's
Yeah,
okay.
no
It's a
problem.
team
Yeah,
effort. We're
thank
here
you,
to help
Mike.
each other.
Yeah, real quickly, to that point, do we know, is there any current legislation or bill that's been filed? Because they're in the, in the budget process right now, doing the governor's released her budget. It'll be the budget from the House Ways and Means, Senate Ways and Means. Do we know if there's anything right now that addresses this.
Are you
Yes,
taking that, Glenn?
yeah, I'm happy to, Roland, if you want me to.
No, I was just going to say the last thing I had seen was what was out there was not particularly commission friendly.
Yeah, that's a good point. That's the bottom line. Basically, the Department of Treasury filed a piece of legislation to force the RPAs and maybe a few other holdouts to have us pay some sort of contribution, and then the Mass Association of Regional Planning Agencies, MARPA, on behalf of the 9 or 10 RPAs in question, because we're not all under this, we filed competing legislation. Those two competing pieces of legislation are winding their way through the state legislature, through committees, and both have received hearings, but they're essentially dying in committee before they get to the floor. So that's the status of both pieces of legislation. I'm not surprised because 4,000 pieces of legislation get filed every year, only 200 get passed. It's a good thing if the pieces keep dying or our legislation gets passed. The latest, which would be financial implication, is if the State Department of Treasury gets its legislation passed, we'd have to pay either the full boat or a percentage of salary and percentage of payroll. That's what it was looking like, maybe 5% of payroll a year. So everything's up in the air. Legislation's been filed. Everything's to be determined.
Yeah, yeah. Excuse me. That's just we're kind of left hanging. Then it sounds like it. I mean, we don't know exactly how this is going to sort out, and I wonder if there's a time certain or there needs to be some solution. It's been going on for a while, as I understand it. Trying to reconcile.
And if these pieces of legislation keep dying in committee, that's actually the best outcome right now, because the other outcome is that if the Department of Treasury gets its way, we're going to pay a lot of money.
Yeah.
If the Department of the Treasury and RPAs come to some agreement outside of legislation, we'll pay a little bit less than a lot of money. If they continue to be filed and continue to die, and we continue to make this, which I loathe, but continue to make it a political process and kill the pieces of legislation, we don't pay anything. So those are basically, that's what's going on, Peter.
All right. Thank you, Glenn. Yeah. Sorry, Roland. Thank you.
That's okay. Okay. We all set?
All set.
All righty. The second one, which is GASB 75, deals with the post-employment health benefits. It feels that presenting actuarially determined liabilities that can never be, nor are they required to be paid, is a good thing. That's what at least GASB feels like. But MRPC has internally established a segregated cash account to set aside funds should a decision be reached to endow a trust to guarantee the funds are there. Obviously, this has always been intermingled with however this pension situation ever gets resolved. And I think at this time, your best position is to keep on doing what you're doing. Other agencies have trust funds with large balances that are now beyond the reach of the commission, because once you set up one of these trusts and put the money in it, you can't bring it back unless you shut down the plan and you start following GASB 75. And it's not necessary. One of my other agencies has a $750,000 fund, and they're using that to cover annual premiums of $40,000, the retiree premiums, when this amount can be paid out of annual resources. So like I say, I think what you're doing, setting it aside in anticipation, and if something comes up that you need to move the money, then obviously you've got it set aside and you can react accordingly. Anything on 75 on the post-employment health?
So Roland, I mean, basically stay liquid. Don't put it in a trust.
Well, you put it in the trust. It's it's gone. It's out of your control.
So stay liquid. Make it a liquid, a liquid asset, basically.
Stay liquid, because essentially what you're doing is you're in a pay-as-you-go system, and there's nothing wrong with that.
Right. And to be objective, if we did fund it, would we, not try to prepay it too much, because once you pay it, it is gone. If we did a trust, then just put the money in like the annual allocation and not try to build up to $1 million.
Well, you could. Well, you know what it is. It all depends. A lot of this money that these other agencies have, they didn't put $750,000 into it. They started out putting probably 20, 40, 50,000 a year, and this is obviously market driven. So it's invested in, whatever they, whoever they decide to give the money to, the type of items you want to have your money involved in. And I would bet probably out of the 750, maybe 400 of it is just growth. It has nothing to do with contribution. But again, it's nice to have that growth, but your hands are strung because you can't say, because we take 150,000 out of that, we need it over here. And the only way you can do it, like I say, is shut the plan down.
Right. So keep it in MMDT, and we have access to it. It's liquid.
Keeping it
It's
set
slow
aside,
earning.
as long as you build up maybe enough to have a couple of years of, I think your payments this year were about $31,000. So if the premiums are going to be, continue to be in that range, then maybe if you've got $70,000, you're good for 2 years. You can have a year when maybe you can't, maybe you have to take something out of that account.
Maybe do a trust for up to 72 years worth. Okay, thank you. That's crystal clear.
Yeah,
That's very, very helpful.
Yeah. But you know what it is that the idea of funding this thing is to guarantee that over an extended period of time, money will be there. So if you never start that process, the risk can always be that for people that are just starting in now, 20, 30, 40 years from now, that money may not be there. So none of us will have any interest in that outcome anyway, but that's.
Okay, I'm going to take this because I think we can just make this decision in the room. Linda and Mac, I'm looking at you guys. So if we do 2 years worth, that's cool. Okay, thanks, Roland.
Okay.
Can I ask a question? This is
No,
Phil
go
Duffy.
ahead.
If that money is conveyed into a trust fund, who manages that money?
You
The
can
state
take
trust
from
fund
a couple of different agencies, ICMA, or I think PRIM does it as well.
Okay. And just for the sake of argument, right now we're at a high interest rate time. Are these typically invested in bonds or other instruments that are enjoying a higher rate of return at the moment?
I guess you can direct them. That's the only involvement you would have as trustees of this money, is you could direct them as to what you want to put your money in. Obviously, some of the other agencies that I have experienced a significant decline in this past year. Some of them about $150,000, $200,000 because the market, is obviously behaving the way it has been.
It depends on where you invest it.
Yeah, exactly. Bonds go down, everything goes down. Sometimes they go up. Lately, not so much.
Okay, thank you.
But those would be your decisions. I mean, I obviously as the outside auditor, that's not my purview to make those, decisions for you or even often suggestions in that regard. Okay. All right, now I want to go on to the bound financial statements. I had indicated in an email to Linda that I was going to cover specific pages, and so I don't know if she wants to follow in that direction. I'm going to start with page 11. There's a footnote, not necessarily a footnote, but at the bottom of that page, item H. Okay, where it says component unit. Now, the commission has one component unit, which is monitored as MEC. And the reason that it is considered to be a component unit is because essentially it's controlled by the commission. Get the same people on the boards on both sides, even if they're not all the same people. There's still financial control, obviously, is exerted by the commission. So therefore, the financial statements and the financial activity of the component unit should be presented in the statements. Now, they should have been in the past, kind of just catching up on this and getting it in there, obviously, before it becomes a concern maybe sometime in the future. So we're going to go through that. This is essentially, for this particular year that we're making this conversion, had a minimal impact on the commission's financial statements. So we'll go through exactly what that impact is. Now, page 13. This is the other item tonight. that is really going to be a treat trying to attempt to get you to understand this one. This is GASB 87. Essentially what that does is it covers all leases that are for more than a year unless immaterial. Let's say you've got a postage meter and you're renting that. So at least you get away from having to deal with that. This accounting policy creates an asset and a liability of equal value. An example would be, would equate to buying a house for $300,000 and having a mortgage for the same amount of money. For some reason, they see some value into you creating on your statement of net position what's called a lease asset, which means they're trying to give this intangible item of value. And they think it has value. Well, it has value because you've got an agreement that's going to allow you to be in a particular location for a certain amount of time, provided you follow the covenants of what's in there, primarily making the payments. Then they create what's called a lease liability. It's that, okay, you've realized that you've got an asset because you've got this intangible that they believe is worth something, and you've got a liability which consists of the present value of the lease payments that you have to make over the term of the lease. The last paragraph on that page 13, at the bottom there is the item N, the adoption of the new lease standard. And it indicates how the lease obligation was determined. It's measured and recorded at present value of future lease payments. Anybody I think that's either had a finance course or whatever would understand these concepts. First thing you have to do is determine a discount rate. Well, obviously the commission had a loan at some point in the past, obviously too far away, removed, to determine, well, let's use that as your discount rate. So what was ended up being selected is we're using the prime bank loan rate as determined by the U.S. Reserve as of the effective date of the lease. Now, the effective date of the lease, you've probably been, I don't know how many years into this one, but because the GASB 87 is effective July 1st of 21, that is as if your lease started on that day. So if it was a 10-year lease and we had 7 years left, the determination of the value of the asset and the liability would be the 7 years that you're still there. If it was a 7-year lease and you had a couple of 5-year opportunities for 5-year extensions, then that makes it a 17-year lease. And the numbers just get larger and larger and larger. I think you had, I believe it's probably 7 years, I think was what was the computation was based on. Any questions on that at this point? I mean, it's just another concept of throwing something on the statements that you wonder what the value is to the reader, particularly like the 68 and 75, when you start throwing on these liabilities that really don't particularly mean anything. You know, the shock value of them is over probably within a couple of years that you're adopting it, and then these things just sit there. And you know, future readers will say, okay, what is this? And try to, you know, comprehend it. It's like I say, it's 68 kind of passes over time. We must be close to 10 years into that. And you know, if you don't deal with it on a regular basis like you guys are, or like I do because of auditing governmental agencies, then it really doesn't mean anything to you. Most of you are probably planners from cities and towns. You may not have, you know, understanding of finances as much as GASB would like you to have, and they kind of push these things on you, whether you want them or not. The problem you have with it, and as I had reached out to GASB, I went to the technical hotline, and I posed the question of if an agency doesn't want to adopt 87, you know, what's the implication of that? One of the implications would be you have a qualified opinion. Now, earlier on I mentioned you had an unmodified opinion, meaning that you're following all the GASBs, you're following all the accounting principles that you're supposed to. If you said, okay, we're not going to adopt it now, and if you don't adopt it every year going forward, you've got a qualified opinion now for the, you know, for the remainder of the life of the agency, or until somebody says, well, all right, we give up, let's do it. So I think it's best, even though these things don't make a lot of sense to a lot of people, you just keep going along with them and rolling on. I'll be discussing yet another GASB at the end of this presentation, and another one where you're going to have another pile of nonsense rolled into these financials, but we'll get to that at the end. Any questions on this at this point? The determination of how this asset was realized, and at this point there were no other items in the lease that would cause this to be what I would say messed up. The asset value and the lease value are the same. There are situations and examples that when you take courses on this, if you have somebody puts down a $10,000 payment, or if you've got some other different things going on, the numbers get a little more bizarre than what they are. Okay. Now the next page is page 15. You can roll that up. Okay, just a little bit more. Okay, right there. Right there, you'll see right almost at the top of the page, you see capital assets being depreciated. Those are the ones you've always had before. You've always had equipment, computers, fixed assets, plotters, anything over a certain value that needed to be capitalized. Those are your hard assets that are being depreciated, physical things that you can actually touch. Now we see capital assets being amortized. Now this is just a lease asset. This is an intangible. Now they've just, like I say, come up with this thing indicating that it needs to make a presentation, and they actually put it in capital assets. I don't know why they do that. Probably should have another schedule for just the intangible. But the 197,636 was the value, the present value of all the rent payments for the rest of the term. And obviously the liability that was put on the books is the same number. Now what you have is, as you make payments, you're actually making payments essentially on what would look like a mortgage schedule, where you have not just so much, the 32,939 is really principal, and there is another component to this, which is interest. And I'll get to discussing how that works out in your indirects and so on, and have another comment about that number itself, the 32,939. Any comments on this, or other than why are they doing this? Okay. Page 16. Now we've got what used to be a very small footnote on lease commitment has now turned into half a page with extended discussion. In the second paragraph, I had mentioned that the last sentence of that, the components of lease costs are the 32,939 of amortization, and there was also $6,012 of interest on the lease liability. Because like I say, they're treating this as if it were a loan. And so obviously in a loan, the purpose of determining the present value is how much of what you're making payments for represents interest. The rest of it will represent liability reduction. And the interesting thing, I probably have this note, a comment to be made later on, but I'll make it now, is that the 32,939 of amortization and the 6,012 of interest is in the indirect cost statement, and it goes into the calculation of your overhead rate. The interesting aspect of this is that the combined number of 38,959 exceeds the amount of rental payments that you made during the year. This will eventually even out over the 7-year period left. But like I say, this is needless confusion, but you know, this is how it goes with GASB. Now, what is on this list, you'll see the 2023 number 2425. Those are present value amounts for payments made in 23, 24, 25, and so on. These are not the lease payments, the amount of lease payments that will be made. The lease go up every year, so obviously the present value for that particular year has to be readjusted. And this is done out through the end of the lease period. So the total minimum lease payments you'll see there, if you could just scroll it up a little bit. Okay, right there. Total minimum lease payments is $184,000. That's the present value of it. And less the effects of discounting, so which brings you down to what your lease obligation is at the end of the year. So you'll see that the value before of the amortized amount was $164,697, and the loan, or I should say the lease liability on your statements is $169,833. And that's primarily, as I mentioned, that the amounts of the computation are in excess of the rent. So it changes the makeup, where you used to just have a rent expense. Now you've got these other things that don't even match the rental payments that you're making. And then we take out the current portion, which is the present value of the rental payments that are going to be made in fiscal 23, and leaving the long-term obligation of 140. Those numbers will be shown on the statement of net position. We'll look at that when we get to the 5-year statements. Now, is everybody thoroughly confused with this, or just want to move on because this is not really?
Moving on sounds lovely.
Moving on sounds good, doesn't it? All right.
Roland, can I ask a question?
No?
Can I ask a question, Roland? It's Linda.
Yeah.
So I'm assuming there'll be a monthly journal entry that we will have to make in addition to obviously the check that we send to the landlord.
Yeah.
Okay.
Yeah.
Hoping you'll
You'll be
set me up
provided with
that.
those. You'll be provided with those. I mean, at this point,
Thank you.
we're almost 9 months into another year, so you can
Right.
save the entry probably for June,
Okay.
and make it at that point.
Okay.
But yeah, it gets kind of difficult because you're making a rent payment and you say, well, where are we supposed to put the rent amount? Because it really doesn't, it doesn't really go anywhere.
Right.
So, we'll discuss that, how that's handled.
Okay. Thank you.
Now, okay. At the beginning, I mentioned about the blended component, about MEC being brought into MRPC statements. Now, if you can move to page 25. Okay. As I had indicated, in note 2, and we had covered that that material. This is we'll call it the condensed statement of net position, and there is not a lot going on in MEC in fiscal 22. Essentially, what you had was you had some cash, you had a liability, which is current, which was deferred revenue, and you had net position unrestricted. Those 3 items find their way into the balance sheet of, I should say the balance sheet, the statement of net position of the commission. Now, you're not going to see this on MRPC's books. This is just doing a columnar presentation where you put, here's MRPC's assets, liabilities, net position, here's MEC's, you total them up, and this is the number you present on MRPC's. You're effectively taking the activity over there, the assets and the liabilities and the revenue and the expenses, and bringing them over as if MEC were just a contract within the agency itself. Okay. Sometimes you wonder, well, what's the point of continuing an agency like this? Some of them, I have others that do have these outside agencies, and some of them are getting money that are being given to 501c3 organizations for purposes that they can't give it directly to the commission. The commission can't accept the money. So the agency sets up one of these entities. It gets IRS approval as a nonprofit, and they can take the money in and obviously then turn around and contract with the commission for the things that this other, the contributing entity wants to have accomplished. So that's the reason behind doing all of this. It really brings everything all together as if this thing didn't exist. So that's the point of it. Like I say, it hadn't been done in the past. Not a bad year to have taken this on because I've got one other agency with a couple of nonprofits, and their statements are going to get turned upside down because they have a lot of activity going on, and also they have real estate that they own, and that goes into both of the entities that they have, and it just, again, makes a mess of this.
Excuse me, Roland.
Yeah.
Mary Jo Bohart has a question.
Yeah.
Please go ahead.
Yes, I have a brief question, and Roland, it might actually be more for Glenn, and it's just a curiosity question on my part. Is the Montechusett Enterprise Center something that is less active currently? Would it be accurate to say it's winding down, or is it in a holding pattern? Could we see in future years this aspect of the financials becoming more robust or more active, or is this kind of par for the course? How does that fit into things?
So I can take that, Roland, if you want. It's more of a management stuff issue.
Yeah, that's all yours.
Mary Jo, it's a great question. So MEC was created in 03. It was created for two purposes. It was created to help with job training, job creation activities, and affordable housing activities. We never did anything on the economic development side. We did stuff on the affordable housing side. We built 3 40B single-family homes in Fitchburg and 2 or 3 in 1 or 2, I'm sorry, in Athol. We tried to do a couple in Ashburnham. The activity in MEC is directly proportional to the staff you have available to deliver services. And right since 18, when we lost our community development manager, we haven't had staff to really fuel MEC. Those are the people that go out and get money and bring services and programs. Holly and I are talking about doing, some training programming and going out for funds to do that. It would be under the guise or the auspices of MEC, because to Roland's point, yes, a 501c3 can get money and RPA can't, and vice versa. So right now it's in a holding pattern, and I love that phrase, Mary Jo.
Thank you, Glenn. I guess, Roland?
Okay, now we're going to move on to the 5-year statements. If we're done with all the new stuff, we'll be discussing some of that new stuff anyway in a 5-year. If you can bring up the statement in that position. Okay, there you go. Now you'll see that the cash and cash equivalents, I indicated to you a few minutes ago that MEC had about $26,000 in cash. That is included in that 496. And so, like I say, it doesn't have that significant of an impact, so that should the state be saying, hey, look at all the money they got because they had this other entity over here that we didn't know about. So, they can probably pay their pension, amount that we're looking at. Now, the next one is down to non-current assets. You can see it right there. It says receivables revolving loan fund. The individual who owed you on this particular fund, you'll notice from 20 to 21 made no payments and had the presence of mind to, I guess, get ahead of this and I think make up a couple of years and bring it pretty near current. A significant amount of cash coming in to the agency, which obviously builds up the cash position that you have. That cash is in the cash and cash equivalents of the non-current assets. All that revolving loan fund works within that section of that statement. And now you'll notice from 2021 to 2022, the next line, furniture and equipment, primarily that is the addition of the lease asset. And so it obviously kind of skews. I think you just went on a buying spree and you must have some pretty nice facilities there, but it's just primarily made up of that intangible asset. Now, if you can scroll down to the current liability section. Okay, right there. The deferred revenue, the next to the last one in the current liability part, that is MEC. And so that's the only thing they bring to the liability section. The lease liability that you'll see there, the 29,697, I went over that before in that 5-year schedule, that is the current portion of this fictitious lease liability, as I would refer to it as. Now, a little further down, you'll see in the long-term liabilities, the 140, the lease liability as well. That's the rest of it that goes beyond what's due within a year. Just a little below that, we've got the net OPEB liability, and you'll see that it's been a substantial reduction from the previous year. We live in a world of actuarial computations that I don't pretend to understand at all. You have situations that occur, staff leave, older staff leave, younger staff come on, and you would have a predisposed position to say, well, if the young people are in there, then the expense should be lower. And then you think, well, no, maybe that's not the case because they're going to be here longer. And, we're going to have to continue to keep money put aside for them. So like I say, I don't really grasp the concepts of what they're getting at. There are changes in assumptions that can be made. I think part of it is dealing with, at the point in time, rates that were being, they were jacking up the interest rates. And so what was going to happen is the assumption would be that you'd be able to make more money. But of course, you don't have money invested. So that's really not, available to you. But when you make the same presentation to the actuarial firm and they come up with these numbers, we're just left to book them and move on. So like I say, that is the fictitious liability, the $1,393,000 down from $1,751,000. So if you think you're doing better, I guess that's a good feeling to have. But to me, I've always explained that this stuff isn't real. So I advise people not to pay much attention to it. Because if you look down, if you just scroll up a little bit more, you're going to see in the net position that we actually set up a line called unrestricted OPEB. And it happens to be the same amount that's in the liability for OPEB. And that's primarily driven by the fact that you don't have any money invested. You don't have even more arcane items to add, deferred inflows, deferred outflows, different things, different things to add onto the statements that you really don't want to know about. But so that's essentially on the statement of net position, the things I wanted to bring to your attention. Has anybody got any questions on that? I want to make any comments? Or? All set. Okay. The statement of revenue and expenditures. Pull that up. I'm going to start in the revenue section, so if you can just pull that up a little bit more. Okay, right. Now the total revenues have gone down 8% from the previous year, and it's primarily from a lesser amount of local contracts. That's been probably the driver of it. If you look at the line just above total revenues, other local revenue, it's gone from $308 to $11,000. That is primarily driven by MEC. MEC did make a little bit of money last year. I think they made about 10 grand. And so that makes up most of that other local revenue. Again, not having a dramatic impact on what's going on for outside readers. The other item is you're down in there under expenditures, the indirect costs, essentially remaining level over the years, which is a good sign. That's the one that you'd like to have control over. The one you don't have is obviously direct salaries, because you have at times difficulty, as Glenda mentioned, about finding staff. And if you've got the work, that you possibly may have to turn it away because you don't have people to do it. And then obviously you can run into situations where you're on the other side where you've got too many people, and then you've got to make decisions of retrenching and cutting back. But at least the indirects are staying at a level pace. You don't want to see that kind of take off on you. Now the operating deficiency, if you just move up just a little bit more, you'll see the 129,407 up kind of dramatically, because last year you had a couple of grants that were had some significant overruns associated with them. That's been eliminated this year, and so this is essentially the real profit. And by that, what I mean the real profit is, you go back down to the next line, the OPEB revenue or expense, and you're adding $358,000 so that the rest of the financial statements look like you made $487,000. Now, the significance of why I say the OPEB revenue expense should be ignored is primarily this. You look at the year 2020. Now, they're telling you you've got an OPEB expense of $441,000. Now, it begs the question, where do you put that in your financial statements? You've got columns for direct salaries, direct costs, or unreimbursable. Now, what the agency does, it puts it in unreimbursable. Because if you put this under indirect cost, you can imagine what's going to happen to your rate. You'll probably never get a contract from anybody. You're limited with Mass DOT for 155%. This could go to maybe 155,000. I mean, it's just, like I say, to me, it's best to ignore that in all respects. And by putting it, I think for certain positions in the statement, we put it in either unreimbursable expense or we put it as revenue, but it's kind of unrecognizable revenue. It's there because we have to make these entries to book it. Okay. As I mentioned, the indirect cost rate up just a little bit because obviously the direct salaries are down. They generally go hand in hand. The higher direct salaries you have, obviously, the lower the indirect cost is going to be. And it's gone up 10%, which is still manageable. It's been higher in prior years, as you can see in 2020 and 2019. Now, in the indirect costs, fourth one down, you'll see the retiree health insurance. We were just discussing that. You'll see over 5 years that the required contributions that you've had to make to your retirees is kind of minimal in relation to what the actuarial contribution would be if you had set up this fund and went through that process. So I say if you want to go into a trust, wouldn't set aside a whole heck of a lot. There's probably some, I don't know if it was just this one or in the pension computations, but there are some people that I've seen, and I believe your agency and others, that individuals have retired and they're not even being listed as owing GIC for the money. They're not even being listed in the money that the state is looking for having paid retirement benefits. I mean, people that I've known from other planning commissions that have been there for just a number of years and obviously were at the top of the pay scale. One guy in particular is not even there, and he's collecting his pension. So, the record keeping on their part is pretty pathetic, and you think they'd want to get that straightened up before they come after you with, what they want from you. But of course, you're in a better position if they just drop off half the people and just, I don't know, the state is pretty awful in a lot of things, a lot of respects in regard to government agencies that I deal with. So I'll just leave that statement lie there. A little bit further down, you're going to see down from retiree health insurance, you're going to see rent. You're not going to see any rent in 2022. Now, what's happened is the utilities have been segregated. You'll see them in a couple of lines down from that. So that would have been, the rent would have been whatever the payment was plus the utilities, but it's necessary to segregate it because the rent is now being segregated under the item called lease expense. And as I mentioned earlier, that is not even what you pay in rent. So, but we put it into indirect costs because it's going to get a little bit crazy to try to keep track of what should be, what should be in there, what shouldn't be, because of this factor of the present value computation that they've come up with. So I say this will wind its way over time. If you've bought a house, you've ever had a mortgage, and you've had the luxury of maybe seeing it get paid off. As you get closer to the end in the last year, you're looking at making a payment, and you're seeing about 98% of it going to principal. And it's a great thing. This is going to work the same way, where the amortization, I should make this comment, is fixed. Oddly enough, the amortization is fixed. It's the reduction in the liability and the interest, which will get adjusted on an annual basis. So it's just an odd situation that they've come up with, and they think this is of value to people. And the only other one I wanted to cover on this page is the professional fees. And obviously they're up substantially from prior years, except for back in 2019. And I think it reflects those instances when you're involved with employment issues that need to be resolved, and obviously you need the assistance of counsel. And so I just bring that up, so if you were looking at it and you say, what's that about? Well, now you know. Any questions on this particular page?
Hey, Roland, can I just add to that? That's a really good line item to point out, because out of the professional fees also come when we do a salary survey, a compensation plan about every 3 or 4 years. So I think if you look about 3 years back, there's a figure there. Let me find it. Hang on just a sec. Professional fees with like 24 grand, 15, then 16 and 30. The 30, 382. That would have been the year that we had a compensation consultant. But it's an excellent point, Roland. Thank you, because we will get stuff sporadically every few years. Thank you, sir.
Yeah. Okay.
Can I ask a quick question?
Yeah.
This is Jackie. Where are these all of our numbers, or who's responsible for putting this spreadsheet together?
I do it because I actually prepare the financial statements from the information that I receive from Linda and Glenn.
Okay.
We have she provides me with a list of, I believe last year they had 52 contracts going at one time. And so obviously the software that they own will calculate, will keep track of all the costs by individual contracts. And at the bottom, we'll spread out the indirect costs to those contracts. And what that does, obviously, is allow you to make sure that for people who you can collect everything that you can from them, these costs become important to track, and also the application of the overhead rate as well.
Geez, it's too bad there wasn't an easier way to.
An easier way to. I was just writing easier way to do what?
Well, I mean, you were making, comments about some of the things they're, what is it they're asking for, or maybe I misunderstood what you were saying as far as, like, it's too bad they couldn't streamline it a little bit better, or to make it more, you know what I mean?
Well, these are the actual expenditures of the agency, give or take, these nuances like this GASB 87, where you're actually recording expenses that don't match up with the cash outlay that you're making. But the rest of this stuff is the real activity that goes through the books.
Okay. All right.
The only one that I bring to your attention is that OPEB, because OPEB would have such an impact negatively on the agency, depending upon how you present it. And, that's why I have it listed as on this particular form anyway. This is a document that obviously only you get, this 5-year scheduling. This is just try to give you comparative analysis over a 5-year period, kind of little analytical procedures to just say, oh, look this. Oh, this one's running well. What happened here? Kind of like explaining the professional fees. What happened there? Why did that do what it did? And understanding, the implications. So.
Yeah, most people don't get all of, all of these line items. Most people don't get that they pull a lot of stuff together. So it's nice to be able to see it, fully, so where things are going up or going down.
Yeah. Oh yeah.
As far as transparency is concerned.
I've actually was looking at the statements of another commission that had asked me to bid on doing their audit, and they don't even list. There's a schedule in the back of this audit. I forget what page, on 36 or so. It's a schedule of indirect costs, and it gives you what that 2022 column is. lists them out pretty much in the exact order that you see there. It tells you what the overhead rate is. They tell you in a footnote what the overhead rate is. They don't put a schedule of indirect costs in their audit, which if you read the Mass Dot contract, you're supposed to. So we're following, what Mass Dot wants. I mean, they want to see this stuff. I mean, if you go in and tell them we spent $812,000 on indirect costs, you're just supposed to nod and say, yeah, that's good. What is it for?
It's like working for NIH because, I mean, you're given a blanket amount, of indirect costs, and they want to make sure that you capture every single cent.
Yeah.
There's no fooling around with that at all.
Yeah.
So.
Yeah, and there's no fooling around here too. It's a good, Jackie, that's a great point. And everything's tracked to the penny. Yeah, so well.
Which is good. And the audit found no findings, which was, that's pretty awesome with the volume. So thank you.
Okay. Now, I mentioned before, if there aren't any other questions, I just want to bring you up on the latest GASB, which is 96. And this one is effective in fiscal 23. This is similar to 87, but this time what they're going after is IT arrangements. So if you have any long-term contracts, let's say for these Zoom meetings, you decide that you get a deal from if we go with these people. So we take a 5-year contract with them. That's no different than the 87 lease. They want you to take these IT arrangements and do present value computations. I mean, this is getting beyond silly. The only one I'm aware of at the moment is there is what's called a Milliman contract. They have a 2-year arrangement with an entity, an actuary, who does the OPEB computation for them. And so this would be something that, how do you make a present value computation of a 2-year? Because it's beyond a year. This is the stuff that's going to have to happen. So you've got to look at all of the IT items that you may have. You may have contracts that for different things, computer situations. Maybe you're purchasing some kind of a computer software, not on an annual basis, but maybe over, extended a period of time. That's the kind of stuff that 96 is covering. But again, it's kind of 87 with just a different hitch to it. Okay. Well, that's all I got. So if there's anybody got any questions or any comments or on it?
Well, thank you, Roland.
Okay.
It's clear as mud.
I always make this comment at the end of the presentation. It suggests that you vote on the acceptance of the audit because the date that is in all of the opinion letters indicate that the statements are available for issuance. So by having this, you can now issue the statements if you approve them. Okay, it's just a kind of a procedural matter.
Do I have anybody that'd like to make a motion to accept? I think it's accept your presentation?
Mr. Chair, it's Jeff Tillotson. And first thing,
Yes,
I want to
Jeff.
say thank you, Roland, for the Jeff Tillotson Air Mass. Thank you very much for making this presentation. In the beginning, you were talking through some notes, and I believe you were talking about a note N on page 13, roughly.
Note N on page 13.
If you could scroll up to it. I'm sorry, but the
adoption of
the OCD in me caught something, and we're gonna laugh about this. Maybe it's before that, but we have a year as 22/023.
Yeah. I got that. I got that typo. That's
appreciate it. That's all. And I'm not throwing you under the bus at all, Roland. But
that's on page 16.
Hey, I didn't write it down. I just happened to see it. But if we're going to vote this through tonight, why don't we have that fixed? So.
Oh yeah. No, by the time you get the final that typo, and I think I had one other one that's going to be corrected. Well, they've already been corrected here, and this change has already been made. So when the final
I appreciate that. It's just
statement is released, that stuff will all be taken care of.
You want to give somebody lack of faith in an audit. something like that will cause all kinds of baloney. I hate to say it, but
Yeah.
with that, Mr. Chair, I'll offer to make a motion that we vote on the acceptance of this audit as presented.
Very
And
good. Thank you,
I'll
Jeff.
second.
Do I have a second?
Yeah, second. Peter Cunningham from Groton.
Peter Callahan. Do we have any questions before I call the roll? Not hearing any. Alan Pease.
Aye.
Jeff Tillotson.
Jeff Tillotson, aye.
Guy Corpusero votes aye. Jackie Doherty.
Jackie Doherty, aye.
Christopher Monroe.
Christopher Monroe, aye.
Laura Schifrin.
Laura Schifrin, aye.
Mary Jo Bohart.
Mary Jo Bohart, aye.
Peter Cunningham.
Yeah, Peter Cunningham, aye.
Phil Duffy.
Phil Duffy, aye.
Robert Schwartz.
Bob Schwartz, aye.
Okay, and that's everyone. Might be a couple alternates in there, but they can sort it out, and it's passed, accepted unanimously. Thank you. Anything else, Roland?
No, that's it. That's all I got.
Okay, any questions of Roland? One last call.
Just
Nope.
want to show our
Thank you, Roland.
appreciation. Thank you.
You're welcome.
Thanks,
Thank you,
Roland.
Roland.
All right. Take
Good
care,
luck.
guys.
You
Bye-bye.
too.
Good
Thank
night.
you.
Okay, the next item on the agenda is item 4, new business, reserved for topics that did not reasonably anticipate. Within there, I'd like to ask, we were talking before the meeting, Bob Schwartz, do you have any updates on the continuation of the suspension of some of the rules of the open meeting law?
I shared an email from MASC, the Mass Association of School Committees, with Glenn, and the extension that the legislature is discussing, or it's in the budget. It's added to the budget. It's in both houses for discussion and vote. And the email did say that it looks like it definitely will pass, and it's to extend the remote meetings through 2025.
Great, thank you, Bob.
That's just coming down the road.
Great. Hopefully it arrives.
I'm
Okay,
gonna keep my fingers
anything
crossed.
else? Jeff, do you
I
have
was just keep
anything?
my fingers crossed. I think it would be good. We've had more successful meetings with more participation here in AIR because we've been allowed to do them virtually,
Absolutely.
and I got more people involved. I like it.
Okay, we do too. Sometimes we've had problems getting a quorum when we met in person, but we haven't had a problem because of Zoom, especially with the way everybody has to come some distance. So hopefully we continue on to 2025. Does anybody on staff have anything, or Glenn, do you? Not seeing anything. I will ask for a motion to adjourn the meeting. And just with a reminder that is it 1 week from tonight we have our regular meeting?
It should, Holly, Linda, help me. It shouldn't be next Thursday because that's too early, right? Holly's
Isn't it
holding up a
April
peace
6th,
sign.
Mr.
Or
Chair?
Oh, yes.
Yeah, April
That's
Yeah,
6th.
it's
right.
two Thursdays now.
Yeah.
Okay, it's 2 weeks now that we have the meeting, and I just want everybody to remember that we're coming up soon for positions for the board. So if anybody thinks they want to take one, it will be another month or two, but the nominating committee will be meeting after the next meeting. And if I'm not mistaken, you can be an alternate. You can basically be anything for these positions. So please consider it. Do I have a motion to adjourn?
Bob Schwartz, move to adjourn.
Bob, move to adjourn. Do I have a second?
Laura Schifrin, second.
Okay, very good. I will call the roll unless anybody objects to adjourning. Alan Pease,
Aye.
Jeff Tillotson,
Jeff Tillotson, aye.
Guy Corbusale, the chair votes aye. Jackie Doherty,
Jackie Doherty, aye.
Christopher Monroe,
Christopher Monroe, aye.
Laura Schifrin,
Sorry, Laura Schifrin,
uh,
aye.
okay, very good. Mary Jo Bohart,
Mary Jo Bohart, aye.
Peter Cunningham,
Yep, Peter Cunningham, aye.
Phil Duffy.
Phil Duffy, aye, with 1 foot already out the door.
Okay, and Robert Schwartz, last but not least.
Bob Schwartz, aye.
Okay, very good. It's passed unanimously. Everybody have a good night.
Yeah.
Thank you.